Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're talking about the current market situation, what's going on, why it's happening and what we should be doing. Now I have seen loads of videos on YouTube discussing this, however none of them seem to be hitting the nail on the head. The current situation in the market is creating a number of investing opportunities. Once we understand this clearly, we'll address the various long and short opportunities which are currently appearing in the market and how also we may want to be hedging our own portfolios. Now this is a serious video. If you're a casual investor who doesn't do DD, doesn't really care about understanding the market, then this video isn't for you. Otherwise, this is definitely one you do want to watch. Now I have split this whole discussion into a few videos so they're shorter and more digestible, and so I will be sharing this mini series over the next coming days and weeks. Make sure you subscribe to the channel so you don't miss these. Now I have seen a lot of videos on YouTube where people are blindly suggesting just buying the dip. Now often these videos aren't coming from experienced investors, so hopefully this video will help you understand whether this is an appropriate strategy for the companies that you're invested into. As part of this video too, I want to dispel a few of the myths which I've seen being shared with increasing regularity, and so we'll address those. Number 1, stocks always go up. Yes, indexes may show this over time that they recover following crashes. However, the companies that make up that index can change, and the index just captures the top companies in that index. Now, an important thing here to read up on and understand is survivorship bias. We will discuss this as part of this series too, but that's definitely worth understanding when we're thinking about this. Number 2, everything will be back to normal in a few weeks. Now, nobody can say this for certain, and it is looking increasingly likely that we may be entering a commodity supercycle with a shift towards value stocks. This in itself would suggest that there will not be a return to the growth stock focused market we'd seen earlier this year and for much of last year too. Now, as an aside, this view of splitting stocks between growth and value is too general, and I'm doing some analysis at the moment which is revealing some really exciting opportunities here. In due course and as part of this series, of course, I'll share those with you as well. Now, the third myth is the fact that there's nothing to worry about. Again, this really depends on the stocks you're invested in. For many stocks, I do agree with this, and that actually, if you're in it for the long term, there is nothing to worry about. However, on certain other stocks where I've seen people just encouraging blind dip buying, I don't think I would agree with this sentiment. I think that perhaps there are things we need to be aware of and maybe need to be more concerned by. Again, this is something else we'll discuss as part of this series. Now, another really important thing just to mention here is the fact that this correction is not the same as the one we saw in March last year. It's driven by different catalysts and different dynamics, and so we need to treat it differently. Understanding this and how it influences the investments we make is critical. I've tried to make this video digestible by everyone, so if at times I'm making things too simple for you to understand, then feel free to skip through. However, in this video we are addressing all the key considerations. If you're new to the channel and you like investing related content, then hit the subscribe button. The YouTube algorithm doesn't like my unpredictable upload schedule, and so oftentimes my videos aren't shown to people. To make sure you don't miss an upload, hit that bell, and in that case you should be notified when videos are uploaded. The channel now also has its own Patreon group and private Discord. If you're interested in those, then check out the link in the description below. If you like the video, please smash the like button, it's so helpful in pushing the channel to a wider audience. And as always, whilst my full-time office-based job is investing, I'm not a financial advisor. This video is purely for entertainment and educational purposes only, but let's get straight into it. Well, over the last few weeks, bond yields have been rising again. Now, if you're wondering why this impacts stock prices, don't worry, we will explain this shortly. Firstly, we need to understand why those bond yields are increasing. Well, there have been growing concerns about inflation in the US economy, driven in part by the large amount of stimulus injected into the markets as a response to the health crisis, or said differently, the interest rates on bonds, which you may sometimes hear referred to as the risk-free rate. Now, without getting too technical, when inflation increases, bond prices decrease, and that in turn drives up the yields, or the effective interest rates. Now, the market's starting to believe and worry about inflation increasing, and potentially reaching the highest level it has been for years. Now clearly, more stimulus is coming, but there's the concern in itself that this could also drive more inflation. There's also growing frustration from the market towards the Fed. It isn't really acknowledging the risk of inflation and saying that it won't change its monetary policy approach. In fact, last week, Powell was speaking in a press conference and he reaffirmed his position that the Fed would not intervene. The markets reacted and bond yields spiked. Anyway, back to the point of why bond yields impact stock prices. Ultimately, a stock is valued on the basis of the sum of the future cash flows it generates. Said differently, a business is worth how much cash it will generate over its lifetime. However, it's not that simple, because cash today is not worth the same as cash you could earn next year. In part, this is due to the fact that you can earn a return on money that you have today, which you can't do with money which you haven't yet received, which you'll get next year. So ultimately, money today is worth more than money in the future. So to understand exactly what the sum of these cash flows is worth today, a common approach is to use a methodology known as the discounted cash flow analysis. If this sounds like double Dutch to you, stick with me, it will all make sense. I'll work through some examples shortly, which will help you understand this a lot more clearly. On the contrary though, if this is a bit too basic for you, feel free to skip ahead a couple of minutes. Ultimately, this all sounds much more complicated than it is, because in essence, all it does is, using a couple of different steps, calculate what the value of those cash flows in the future are today. And ultimately, a big part of this calculation is bond yields, but specifically the 10-year US government bond, also known as the risk-free rate. Now, we aren't going to go into this in huge detail here, but ultimately discuss a few of the variables which explain why higher growth stocks decrease in value by a larger magnitude than those which are considered as value stocks when interest rates rise or when bond yields increase. So to understand how we value those future cash flows, we need to understand what discount rate we should be using, or you may also have heard this referred to as the weighted average cost of capital, or the WACC. Now this is the figure which the future cash flows which a company generates are discounted by to determine what they're worth today. The higher the discount rate, or the WACC, the less the future cash flows are worth, and the inverse is true as well. So ultimately, when the discount rate is lower, the value of those future cash flows generated is greater, and so the stock's value will increase. And specifically with growth stocks more so than value stocks. Just look at how this developed in March 2020. The bond yields fell, and ultimately we saw an increase in stocks valuation from there, but specifically and particularly within growth stocks. In simple terms, however, the discount rate is a combination of the cost of debt the company has and the cost of equity for the company. The cost of debt is simple. This is how much it costs the company to raise debt, whether that's bank debt, bond debt, or any other sort of debt the company can raise. The cost of equity is slightly more detailed, but this is where we get into the meat of the point. Now, there is a complicated formula for this, and that's on screen now. This is the formula for the cost of equity. It looks complex, but it's actually very simple. It's just saying that the cost of equity is the risk-free rate, i.e. the 10-year Treasury note yield, plus the return which investors need to be generating to compensate them for the risk of holding stocks, multiplied by something called beta. Now, we'll touch on beta more shortly, but this is a company-specific measure, so keep this in mind. The risk-free rate is that of the US government bond, specifically the 10-year Treasury note. It's considered risk-free and is the benchmark. So this alone, we know when it increases, will increase the overall discount rate, so will impact stock valuations negatively, as ultimately the future cash flows which a company generates become worth less. Again, the inverse is true. In March 2020, the US government bond yields fell sharply, and this coincided with massive rallies across the markets, but again, particularly within the growth stocks, tech stocks, and the Nasdaq. Now, let's go back to the formula and understand beta and the role that plays in the equation. So firstly, beta is a measure of the volatility of a specific stock. Specifically, it measures how a stock moves in relation to the overall market. If a stock has a beta of 1, this means it moves exactly in line with the stock market. If the beta is less than 1, this means it's less volatile than the overall market and it moves to a smaller magnitude than the overall market. Say for example the stock market moved by 10%, a stock with a beta of 0.9 would move by 9%, either positive or negative. A stock with a beta of greater than 1 moves by a greater magnitude than the stock market. So say a stock with a beta of 1.5 would move by 15% if the market moved by 10%. Working this through, this means that stocks with a higher beta have a more volatile discount rate than those with a lower beta to impacts and changes in that risk-free rate. Said differently, stocks with a higher beta will have a bigger impact on their valuation from changes in the discount rate, the yields on the US government bonds, than those with a lower beta. Typically, value stocks have lower betas, anywhere from 0.8 to 1.2, whereas growth stocks can have higher betas, anywhere north of around 1.5. Now, let's put this into an example and let's look at two fictional companies. Both of these companies generate the same amount of cash flow over the next 5 years, so the same cumulative cash flows generated year on year. But one is a high growth stock and one is a value stock, in the sense that one is starting from a lower base and growing quickly, whereas the other is starting from a much more mature base and growing slowly. However, over that 5-year period, they both generate the same amount of cash flows. For this analysis, we've assumed that the value stock, the one which is growing slower, has a beta of 1.1, whereas the growth stock has a beta of 1.8. This is actually a fairly conservative assumption and in line with the realistic beta for such stocks. We've also assumed that the growth stock has slightly less debt and its cost of debt is slightly higher than the value stock, which has slightly more debt and where its cost of debt is lower. Again, these are conservative assumptions and are very much aligned with reality. Now, the impact of these assumptions is actually quite a large discount in the discount rate for both stocks. However, now comes the interesting part. when you look at the impact on valuation which an increase or decrease in the risk-free rate, again the US 10-year Treasury note, has on both of these fictional companies, it's much more pronounced in the company which has the same characteristics as the growth stock versus the value stock. Now, this is what we're seeing in the market currently. However, there are some dynamics at play here too, many of which are creating some exciting opportunities for us as investors. The buckets of value and growth are too broad and they need to be broken down into more categories within this. From my analysis, there are pockets of companies within each of these buckets which are either overvalued or undervalued. Ultimately, on the basis of my analysis, I have identified a number of companies which sit within these categories, however, which are overvalued or undervalued for a number of reasons. This is what we're going to explore in detail in the next video. We're also going to discuss how changing market dynamics and how greater participation in the market from index funds and algorithmic traders also influences the market, and how that in itself brings with it investment opportunities as well. Anyway, thank you so much for watching and sticking with me. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel and you like investing related content, then make sure you subscribe. And if you want information before anyone else has and a load of other exclusive information as well, then check out the Patreon. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear everyone's opinions and perspectives, so please get involved. Thank you so much for watching, and I'll see you in another video.